Over the last 2 decades, whenever you looked at a product's origin, one country stared back at you – China. But that could all change in the next few years, as you might find made in Mexico instead of made in China on your beloved products. From US tariffs to Chinese companies fleeing to the Western Hemisphere, China's worst nightmares are coming true. So why is China supporting it by investing so much in a country that will potentially replace it? And why are Chinese companies opening shop in the Central American nation? Stay tuned to the very end to find out. And if you're new to the channel, consider subscribing so you don't miss future videos like this. Now, let's get into the video of how China is losing to Mexico. China's rise to prominence as a manufacturing powerhouse has changed the global economic landscape. It attracted industrial investments worth trillions of dollars from across the globe, including the US, Europe, and even East Asia. It accounts for 15% of the global FDI. A young, large population, low labor costs, and lax country rules made this opportunity too hard to miss. Even after accounting for the costs of shipping across the Pacific, companies saw an increase in profits as the result of this shift. However, with China's economic growth over the past decade came many changes, including higher wages, skyrocketing fuel and transportation costs, more frequent currency fluctuations, and most significantly, China's political strength. The current situation in China has caused a mass exodus of individuals and companies numbering in the millions. Given the current economic climate and the ongoing trade war between China and the US, why would they prolong their stay in the country? Because of that, American companies started to re-evaluate their presence in China. They continued their search for other nations, including Vietnam and India, but Mexico stood out as one of the most attractive options. It also proved to be the best option. For reasons beyond its physical location, Mexico has recently become an extremely attractive foreign policy target for the US. Not to mention, Mexico has a more stable government, stronger economic links to the US, and better international relations overall. The government also takes pride in its open regulatory system, which is an improvement over China. The recent upturn in Mexico's economy is something we must always keep in mind. In 2023, the country's GDP soared to over $1.8 trillion, up from $742 billion in 2000. US imports of Mexican commodities were $454.8 billion in 2022, up 18.9% from 2021 and 64% from 2012, according to official US government figures. Additionally, in 2022, the stock of US foreign direct investment in Mexico reached $130.3 billion, representing a 7.6% growth from the previous year. According to these media outlets, the United States is looking for a regional partner to compete with China, and in 2022, it was revealed that American corporations will invest more than $40 billion in Mexico until 2024. So, does this mean that Mexico will take over China's place? Well, it seems like it. Mexico is experiencing a manufacturing renaissance. Many of the 500 biggest American industrial companies have moved some of their production from China to Mexico. It all began when Trump imposed tariffs on Chinese goods exported to the US. Collectron, which facilitates the relocation of foreign companies to Mexico, explains the influx of foreign investment into the country. The tariff jump between China and the US occurred in 2018, and the sad scenario of the COVID-19 epidemic has persisted since then. Because of this, many businesses have begun to practice what is known as friendshoring, or setting up shop in nations that are seen to be amicable to their operations. Alternatively, nearshoring refers to manufacturing near their customers. Well, businesses don't just decide to move their operations somewhere else all of a sudden. The majority of businesses deliberate for 6 months to 1 year to 18 months before deciding to launch a Mexican operation. Mexico has competitive rates and a trained workforce, so it's only a matter of time before companies move to this Central American nation. After all, Having a large number of nearby colleges and a highly skilled and talented workforce is a huge boon to any business. Perhaps the most enticing one will be from Tesla. The company is opening gigafactories like crazy, and in 2023, Tesla CEO Elon Musk said that the company had been considering building a new plant in Nuevo León. But what's special is that this plant will be the largest electric vehicle plant in the world, as Elon announced the $5 billion plus facility. Along with other US automakers, General Motors has revealed plans to invest over $1 billion in Mexico as well. Across Mexico, Unilever has pledged to invest billions of pesos or hundreds of millions of dollars on an ongoing basis. With the construction of this factory, Unilever plans to boost its export capacity to over $1 billion to the United States, Canada, and the rest of the Americas, according to the head of Unilever's operations in Mexico and Latin America. And you can expect to see many more examples like these in the near future. There are some key sectors that are as competitive as China, notably the automotive sector, auto parts sector, and computer manufacturing. In fact, in 2019, Mexico surpassed China to become the biggest global exporter of computers. Because Mexico is now more competitive than China when it comes to wages. The average monthly wage for manufacturing workers in China is approximately $840 per month. And when you move to Mexico, you pay almost half of that, at $480. More than that, Mexico's population has remained relatively constant over the years. Manufacturers now consider demographic stability to be an important element as well. China's population and manufacturing workforce are both on the decline. From its current 1.4 billion, the Chinese population is projected to decline to a little under 1 billion by the year 2080. Now yes, that date is really far off, but investors do take it into consideration. In addition, the median age of the population has been steadily increasing for the past decade. It was just 34.1 years old in 2010, and it's already 39 years old in 2023. And it's bound to increase further thanks to the one-child policy blunder. While in Mexico, it's a completely different story. The current population of 129 million will increase to more than 155 million by the year 2060. In comparison to China, it also has a significantly lower median age, sitting at about 29 years old. Not only that, but things improve drastically when it comes to shipping efficiency and cost. For context, a 40-foot container traveling from China to the United States typically takes 5 weeks and costs $4,300. But the same container traveling from Mexico takes only 1 week and costs $1,800. The benefits are so massive that even China has seen them, as many Chinese companies have had some of their operations in Asia redirected to their Mexican operations. That's right, American corporations aren't the only ones setting up shop in Mexico. Chinese investments in Mexico are on the rise. There have been reports indicating an increase in manufacturing investments from China to Mexico. China's FDI flows into Mexico grew on a nominal basis from $38 million in 2011 to $386 million in 2021. Although China is not the biggest FDI partner of Mexico compared to the neighboring US and Canada, recently it has shown the fastest year-on-year growth. Located in the heart of Mexico's Nuevo León Desert, the world-renowned Hofusan Industrial Park is roughly 2.5 hours drive from the US border. In 2017, construction began on a project with an anticipated price tag of $1.2 billion. The site is not the only investment initiative either. An estimated $606.3 million, or a 76% increase from 2020, went toward investments from Hong Kong and China in 2021, the highest figure since 1999. But what sets these investments apart is the fact that they are aimed squarely at US borders. As of 2022, 1,289 Chinese enterprises have chosen to invest in Mexico. So, what's the scoop? Now, it could mean that China realizes the investment opportunities in Mexico, hence the heavy investments. On the other hand, it could indicate their desire to evade part of the tariffs that the United States levied against China. American companies are paying extra to have their products built in China due to tariffs on Chinese products. Tariffs, which are basically taxes, raise the price of Chinese imports to the US, cutting into the price advantage that Chinese manufacturers had previously. These businesses can save money on tariffs thanks to Mexico's trade agreements by making their items in Mexico. Or to put it another way, Chinese enterprises could be able to sidestep the increased US tariffs on Chinese goods by shifting production to Mexico. Now, another reason why Chinese businesses are setting up shop in Mexico is to be closer to their customers in the US. On the other hand, Mexico has free trade agreements with a large number of countries in the world, giving Chinese companies access to not only the US but others. For example, NAFTA, North American Free Trade Agreement, gives them access to Canada. Since the trade war between China and the US began in 2018, Chinese enterprises have invested $8.29 billion into projects in Mexico. Among these businesses are some big names, like Bethel Automotive, Ningbo Xusheng Group, and Tuopo Group, which makes auto parts. Home appliance giants like Hisense have also moved their operations to Mexico. Since the trade war, Chinese companies are increasingly establishing overseas operations or forming joint ventures. Vietnam and Mexico are two obvious examples. From there, it exports to the United States. To further confirm this theory, there has been a significant increase in Mexican exports to the US since 2018 or 2019, and imports from China are driving the current uptick in exports from a number of these economies. To put it simply, China still exports huge amounts of goods to the US despite the tariffs, thanks to this triangular trade model. Many think that this form of trade isn't sustainable, and if economies are serious about reducing risk, they will also seek to eliminate this channel of trade. That's one aspect. Another is that it significantly increases prices, as is evident already. But despite that, Mexicans anticipate that investment from China will increase much further in the near future. The president of the Mexico-China Chamber of Commerce, Araceli Ching, said that going forward he anticipates things moving at a more rapid speed. The practice seems to be well received by Chinese officials, despite the potential irony of China being a long-term destination for outsourcing self-ascending production across the ocean. It would appear that Beijing is more than willing to outsource low-margin manufacturing to other countries, so they can increase the production of high-tech items like electric vehicles and microchips back home. Companies from China have made significant investments, and the US has taken note. Congresswoman Maria Salazar revealed that China's trading volume increased from $12 billion 20 years ago to $450 billion last year, a growth of 3,000%, and is predicted to reach $700 billion in the coming years. Now, considering US citizens' perspectives on Latin and Central American citizens, it wouldn't be surprising if Latin American and Central American nations would seek out a trading and investment partner. But what do you think? Is moving companies to Mexico a good strategic move by China, or did the country doom itself? Let us know in the comments below.